Good afternoon, ladies and gentlemen. This is Barry Norman on behalf of investing.com, and welcome to our two-week class in Elliott wave principles. Now, Elliott wave principles is a theory based on a well-known technician who developed, and his name is Elliott, who developed this concept that the market works in repetitive waves. It is the only technical analysis that can give you a long-term perspective, which opposes the general misunderstanding that technical analysis can only be used in short term. All other technical analysis tools have limitations to their forecasting ability, but Elliott wave principles cover the entire market cycle. So before one can begin to identify the type of patterns Elliott discovered and the rules that govern them, it's a good idea to first learn about labeling of wave degrees. Counting waves is a skill that comes with practice and proper application of the rules described. It is a good idea to start applying a wave count to a market you are familiar with and update it from time to time. Now, Elliott believed that all markets, regardless of what asset class you're looking at, follow a very strict principle that moves in waves. They move from a ranging cycle to an up cycle to a ranging cycle again, and then down to a down cycle and start over. And this is very, very true. If you look at it, it's like the waves coming in and out of the ocean. They can be bigger and smaller, but they're always going to come in, and then break going out. It's just like the tides go out every day and then they come back in. And it's learning how to apply these to understand where you sit in the current market cycle. Now, Elliott developed his theory in the 1920s. So this was before there was the Forex market, before there was a commodities market, before there was online investing. This was a long time ago when the markets moved very slow, and it was predominantly stock markets. And his theories are still hold true today. Now, Elliott discovered that these market cycles resulted from the investor's reaction to outside influences or predominant psychology of the masses at the time. He found that the upward and downward swings of the mass psychology always showed up in the same repetitive patterns, which were then divided further into patterns he called waves. Okay. Elliott's theory is somewhat based on the Dow theory in that stock markets move in waves. Because of the fractal nature of the market, however, Elliott was able to break down and analyze them to a much greater degree. Now, fractals, and you'll hear the word fractals a lot, and I'm not 100% sure because I'm not a mathematician, exactly how to the detail what they are, but they're calculations. Fractals are mathematical structures which on a ever smaller scale infinitely repeat themselves. Elliott discovered stock trading patterns were structured in the same way. Now, what he believes is the market works in these cycles, and these cycles are based on this wave. Okay. We move up wave one. When we hit the peak of wave one, the markets will ease back down. They'll hit wave two, ease back up wave three, come down to wave four, move back up, and then they'll start a descent down the markets. And when once they peaked out at 5, we start calling these A, B, C, D, and E. Okay, so you have what's called the impulse wave, which is really the uptrend or the up movement of part of the rally. And then you have the corrective, and when they're coming back down, they're labeled with letters. So we have the wave 1, wave 2, wave 3, wave 4, and wave 5 in the upward movement. And then coming into downward movement, we have the wave A, B, C, D, and E. Okay. Now, Elliott made detailed stock market predictions based on a unique characteristic he discovered in the wave patterns. An impulse wave, which goes with the main trend, always shows 5 waves in its pattern. And this now holds true. Now remember, when Elliott did this, he was only looking at the stock market because we didn't have the other market, so to speak. Now, as years have gone by, we find that this holds true in any market you're trading. Okay, on a smaller scale, within each one of the impulse waves, 5 waves again can be found. And in a smaller pattern, the same pattern repeats itself into infinity. These ever smaller patterns were labeled as different wave degrees of the Elliott wave principle. So in each wave, so while we're seeing and witnessing wave 1, which could take place over a week, could take place over a month, could take place over 6 months or a year, we would also find this whole other, within here, we would find this whole other process that would look just like this wave. And then if we were to break down this wave, we would see inside of that wave the same thing, ever smaller. So it depends, no matter whether you're looking at a long-term market or a very short-term market, these waves hold true. Now, let me just get my markings off of here. We'll go to the next slide. Okay. So the theory gained popularity in the 70s. In the 1970s, the wave principle gained popularity through the work of 2 well-known traders, Frost and Pretcher. They published a legendary book on the Elliott wave entitled The Elliott Wave Principle, the Key to Stock Market Profits. In this book, the authors predicted the bull market of the 70s and the crash of 87. So again, we can see this in the wave of the markets. We see wave 1, and it's always saying wave 2, wave 3, wave 4, wave 5, then we have A, B, C, and D. In the upward move, we call this the motive wave. Or remember, we also had it the impulse wave. This is where buyers are buying up to make profit. If you've ever watched an asset trade and you see gold is moving up to $1,200, making all the headlines of the news and all over the place, people keep jumping into the markets to buy, buy, buy. And they're driven by greed. And they will continue. So what happens, you have the first wave, because remember, all of this is based on market psychology. Okay. So you have the first wave. It eases back down. The markets move back up. They ease back down. They move back up. And about wave 5 is when the buyers who were in wave 1 are exiting the market, and the buyers are getting weary. Because also the markets get tired. And this is what happens. The bulls outweigh or just get tired. So we have to be able to identify these. And the most important part is figuring out where we currently sit in the current market on these waves. Because you can't just open up a chart and say, oh, look at that, I got a wave. You have to study them. You have to figure out where you sit in each one of these waves. Once you figure that out, you can continue that wave on indefinitely. Now, there are 2 types of motive waves. And these are the uptrend or the move up or the increase in price waves. We have the impulse and the diagonal. Now, we're going to look at both of these types of waves in a little bit more description. Okay. The impulse wave. Okay, the impulse wave is the kind we have been using so far to illustrate how the structure of the Elliott wave is put together. It is the most common motive wave, and easy to spot in the markets. Like all motive waves, it consists of 5 subwaves. 3 of them are also motive waves, and 2 of those are corrective waves. This is labeled as a 5-3-5-3-5 structure. Okay, so that's a lot of words. So what we have is, here we have the markets moving up to what is 1 in the impulse wave or the motive wave. But in that, we actually can see 1, 2, 3, 5 waves up. Okay, so the overall pattern was 1, 2, 3, 4, 5. And within this, each one of these ones, we see 1, 2, 3, 4, 5, the same micro or smaller wave taking place. Then we'll go from there. As we step down to level 2 in the longer wave, we'll actually see three corrective wave stages, A, B, and C. A, B, C. We'll go back and we'll go back on to moving to 3. And within 3, we'll have 1, 2, 3, 4, 5. Then, once we hit the height of 3, which is equal to here, we're going to go into A, B, C of the corrective wave. We're then going to surge back upwards. Move to 4, A, 1, 2, 3, 4, 5. And you'll find that this is not something somebody made up and happens once in a while. This impulse wave and the rules within this impulse wave always happen. Okay. Just is. Okay. Now, however, it has 3 rules that define its formation. These rules are unbreakable. If one of these rules is violated, then the structure is not an impulse wave, and one would need to relabel the suspected impulse wave. So, because you have to be able to find these and identify them correctly, you need to have rules that allow you to do such. Because otherwise, you're look at any of these things on a chart and say, that's an impulse wave. Okay. Now, let me get these markers and we'll talk about these rules. Let me just get these lines off the chart here for you. Okay. Rule number 1 is wave 2 cannot retrace more than 50% of wave 1. Okay. Now, I give you, there is a handout for you, and these rules are common. These are not my rules. Anywhere you read about Elliott wave and impulse waves, it's the same set of rules. So, in other words, wave 2, which this is wave 2, okay, wave 2 cannot retrace more than 50%. So it means from this point to this point, that entire move cannot exceed 50% of the up move. So hypothetically, if this was $1 and his up move was $3, where it touched, okay, 2 could not come below $1.50. 50% of the move in between. So we went from $1 to $3, so we had a $2 move, and we're at $3, 50% of the $2 move is $1, and that's all that we could retrace. Okay. So this level here cannot be lower than 50% of this total level. Wave 3 can never be the shortest wave of 1, 3, and 5. So here is wave 3, and this can never be the shortest of 1, 3, and 5. Okay. Because this is where the markets are steadily moving in an uptrend. And this is telling you the bulls are steadily adding on to their positions. Okay. Wave 4 can never overlap wave 1. Okay. Now, okay. This is wave 4. So wave 4 is when it's an ease. It cannot fall below the peak of wave 1. So you have lots of rules. This cannot be more than 50% of this. This cannot be the shortest wave. Okay, and this ease here cannot fall lower than the peak on number 1. Okay, wave 2 cannot retrace more than 100% of wave 1. I'm sorry. It's completely correct. It's wave 1 cannot exceed, in other words, when we're going into wave 2, it can't fall below this level. I'm sorry, I just got my numbers mixed up. So wave 1 cannot fall more than 100% of this level. So in other words, you can't have a market that goes up like that and then like that. This level here cannot be below that level. In fact, I'm sorry, I got it mixed up with Fibonacci levels for a second there and I got off track. But that's what this wave 1 cannot retrace more than, wave 2 cannot retrace more than wave 1. Wave 4 cannot be lower than wave 1, and wave 3 cannot be the shortest of the waves. Okay, no, it is not time span. It is price span. Okay. No, I'm very, very sorry. Okay, let me answer. Wave 3 can never be the shortest span. That is the time span. It doesn't have to go any particular level. It doesn't have to reach a particular price. It needs to be the longest part of the uptrend. Okay, so what it can't be is the shortest part of the uptrend. Okay, so wave 3 can never be the shortest of wave 1, 3, or 5. So 1 could happen very quickly. 5 could happen very quickly. 3 has to be the buildup as the buyers are going into the market. It's just not a surge. So somebody asked me, and they were correct. I was wrong. Okay, the old saying, do as I do, not do as I say. Okay, well, so here are the rock hard rules. So let me go with this slide too, because we have a second wave also. Okay, now we have wave extensions. In the majority of cases, impulse waves will exhibit what is called an extension to their normal pattern. This means that one of the impulse waves, 3 motive subwaves, will be elongated impulse with exaggerated subdivisions. This can happen in either 1, 3, or 5, and it typically happens in only one wave. So in other words, what it's saying is one of these can be incorrect. At times, the subdivisions of the extended subwaves look almost the same as the amplitude and time duration of the 4 other waves in the higher degree impulse wave. Now, that's a wee bit confusing for everybody. So instead of having a wave count of 5 for the impulse, it is tempting to try to count 9 waves. As it may not be clear as to which wave is the extended wave, however, it does not really matter in the long run, as the technical significance would be the same, even if one had assigned the wrong count. Okay. So in other words, wave 1, 3, or 5 could go up, or you could have one other movement in the center. Okay. But it can't break the rules, but you could end up with a 9-wave pattern as opposed to a 5-wave pattern, but it would still continue up. Now, wave extensions are not easily identified. Okay. So what we have is exactly what you see on the screen. It's just that instead of having just 5 waves, it actually extends for 9. Okay. And this is something you have to watch for and be careful, because the rule of thumb is you have 5 waves and then you have an ABC retracement. But it's not in the major wave. It is in the impulse waves of the breakdown, not in the overall wave. Okay. Now, you keep asking, several people ask, how do you identify the first wave? I can't tell you how. Okay. You need to apply all of these rules and then search your charts, because that's what it's the key to, is identifying the first wave. So what you have to do is look through your charts to where you see this pattern and then see if the pattern fits the rules. Okay. And that is the hardest thing that you have to do. Now, once you've, because that's it, once you've identified one and you've got it moving to 2, 3, and 4, then you're easy moving forward, because then you've got it on your chart. Okay. So that's why we're spending a lot of time talking about what you're looking for. Okay. There are times when the market has become so overextended in wave 3 that there is not much force left for the impulse wave to come to a proper completion. Okay. When this happens, there is a chance that the last wave of the impulse, wave 5, will not reach the end of wave 3. At this point, the market is overexhausted. Now, you can tell this sometimes way ahead of time, because the impulse wave in 3 is steeper than it should be. That means you had a very steep uptrend in the middle of this movement. So the buyers exhausted themselves. So you need to understand what are the possibilities. Now, we have an impulse wave, and then we have a diagonal wave. A diagonal wave is the second type of motive wave. It is not an impulse wave. However, like all motive waves, its goal is to move the markets in the direction of the trend. Also, like all motive waves, it consists of 5 subwaves. The difference is that the diagonal looks like a wedge, either expanding or contracting. Also, the subwaves of the diagonal may not have a 5 count, depending on the type of diagonal it is. The ending diagonal is a special type of wave that occurs in wave 5 of an impulse, or the last wave of a correction pattern. So wave C of the ABC correction is what you're looking for. Now, again, I know we're talking about a lot of rules and regulations. Okay. In the next class after this, we'll be looking at the current markets and trying to apply these. But you have to learn and memorize the fundamental rules of them all. Otherwise, you'll just be looking blindly for something you don't know how to verify or how it traces. And I'll show you that today's new charts will actually help you put the Elliott wave patterns right on your charts. So it's not so difficult, but you have to, the whole thing, and I started out this whole class was telling you have to learn the rules of the waves. Okay. The wave structure of the ending diagonal is different from the impulse wave, where the impulse wave had a general structure of 5, 3, 5, 3, 5. In other words, wave 1, wave 2, wave 3, wave 4, wave 5, A, B, C, then 1, 2, 3, 4, 5, A, B, C. The ending diagonal for this structure counts as a 3, 3, 3, 3, 3. Wave 1, 2, 3, A, B, C, 1, 2, 3, A, B, C. Sounds like a dance move, A, B, 1, 2, 3, A, B, C, or tracks on a piano. All 5 of the waves on the ending diagonal break down to only 3 waves each, indicating exhaustion of the larger degree trend. Okay. Also, wave 2 and wave 4 may overlap each other. Now, you have to understand, okay, these waves occur within larger waves. First, you have to identify the larger wave, and then these are the subwaves within that larger wave. The larger wave stays a 5, 3, 5, 3, 5, or a 3, 3, 3, 3, 3. Okay. The rules of the exhaustion or the rules of the other patterns are within, and every time we talk about it, we talk about the subwaves. So remember, when we started out, we said, okay, we have wave 1 here. In wave 1, we could have another set of 1, 2, 3, 4, 5, A, B, C, okay, and you can have this within this wave. So when we're talking about the subwaves, these are what is actually contained within this one wave. Okay. Now, this wave, which is the larger wave, should not be variable. Okay. It's the subwaves that you have within here. And then remember, we talked, it's infinitesimal. It can still shrink down. What you first have to identify is this overall wave. Then you have to determine whether that overall wave is currently in wave 2 or wave 3 of your current wave pattern, your Elliott pattern, where price is currently. And then you have to identify what is going on within that current wave or the subwave. So it's looking for the longer and then narrowing it down and narrowing it down and narrowing it down. But you have to have the longer term wave with the subwaves and then the shorter waves. So in other words, most ending diagonals have a wedge shape to them where they fit within 2 converging lines. However, there are cases where the wedge is expanding, though it's rare. Please keep in mind that the subwaves of the ending diagonal consist of 3 waves each are corrective in nature. So as we see here, we have the larger 1, 2, 3, 4 moving down to 5. So we're on, in this case, we are in, we are already in the completion wave of the wave 1, wave 2, wave 3, and we're coming down to wave 4, and this is the subwave within that subwave, and then this is the smaller wave within this larger wave. So you have a long-term wave, a leg of, so this is what we're looking at right here would be, let me just take you back to the chart. Would be this wave between 3 and 4 here. Okay. So that's what we're looking for. We've already identified here the longer term wave. We've come all the way down here, and this is what we're looking at within that wave moving down in that larger picture. Okay. Now, leading diagonals are rare and are found either in wave 1 position of an impulse wave or wave A position of a zigzag correction. So remember, you have wave 1. In that, you can have sub-wave of that wave that has 1, 2, 3, 4, and 5 in it, and then you can have a sub-wave of that that has 1, 2, 3, 4, and 5 in that. And then, so the leading diagonals, okay, only really occur in wave 1 position of the impulse wave or in the wave A position of the zigzag correction. Remember, you went up and down 5 times, and then you went into A, B, C, and D. So it's only in the A or the 1. They have a 5, 3, 5, 3, 5 wave structure like an impulse, but in this case, wave 2 and wave 4 overlap, and they form a wedge, a wedge pattern by the converging boundaries. Okay. And again, this is in the handout that I gave you. Because of the 5 wave subdivisions, this pattern indicates a continuation of trend where the ending pattern, diagonal pattern of the 3, 3, 3, 3 indicates the termination of a trend. After the market corrects and does not correct beyond the beginning of the leading diagonal, one can expect the trend to continue in the direction of the leading diagonal. I know, it's a lot to take in. When the market moves against a trend or one higher degree, they do so with an apparent struggle. This resistance prevents the pattern that forms from developing a motive type of structure, and the pattern that forms are more varied than in a motive type wave. And an analyst must exercise patience and flexibility when dealing with corrective waves. Now, there are 2 types of corrective waves. There's a sharp correction and a sideways correction. The sharp correction moves steeply against a trend of one higher degree, and the sideways correction appears to form a flat type of structure that often goes back to the price of where it began before ending the correction. Okay, so let's follow this. We're finished our upward wave 1, 5. We finished our 5. So we've had 1, 2, 3, 4, and 5, and now we've entered the A, B, and C stage. Okay. In other words, remember, we had the wave going, we had a long-term wave going 1, 2, 3, 4, and this would be 5. So we're now moving between 4 and 5, and we're forming that A, B, and C. After 5, we form the A, B, and C. So in here, we also have a 1, 2, 3, 4, 5 corrective wave. Then we have an A, B, C within here. Then we have a 1, 2, 3, 4, 5 within the A, B, and C. Okay, a signal zigzag is a 3-wave corrective structure that is labeled as A, B, and C, the subwave sequence of 5, 3, 5. We have seen this above in our expanded corrective pattern. The A and C waves are motive waves, with a 5 subwave, while the 5 wave is corrective, often with 3 subwaves. The zigzag is known to form a sharp style of correction, or in an impulse wave usually shows up in a second wave position. Okay. Lot to take in. Zigzags may also form in combinations with forms. So what do we have? We have zigzags, we have corrections, we have extensions, we have impulse waves and motive waves. So you have the bigger picture and then the sub-pictures of what's happening in there, and then the variations of the patterns that you're seeing in these waves so that you can interpret the markets. And it sounds like a lot, but when you're trying to interpret what the euro is doing and where it's coming from, where it's going to, you have to figure out where it is right now, where it is in this picture, where it was in this picture, and what stage is it in this correction. When you do this, you'll find that this stuff works extremely well. Okay, now you'll have flat corrections. Flat corrections are when A and B, or the top of 5, and B are equal in height, and A and C are also equal in depth. Okay. So again, remember, whether we're talking about trading triangles and channel trend, they are all memorizing what those patterns mean. Even if we're trading Japanese candlesticks, we're memorizing what each one of those candles and each one of those interpretations mean, whether we're looking about 3 black crows, 3 patterns up and down, if we're looking at head and shoulders, they're all rules. There's a lot to absorb. It's never easy. But once you found one of these systems that you like and you learn it and master it, you'll find that it's not difficult, and you'll find that you have a very good success rate. You just have to put the effort into finding them. And like I said, next week when we actually go to put these on real live charts, you'll be surprised at how easy it is to find the waves. But the interpretation and knowing the rules is what gets difficult. So then you have an expanded flat correction. Okay, a running flat which occurs in strong trends of one higher degree and will have a B terminate beyond the beginning of the A, but the wave C will fail to reach the beginning of wave A. Okay, so in other words, B here is higher than the 5, A here is here, and C fell lower than the 5. Okay. Again, do you have to memorize all these? No. You have to be able to see them on your chart and say, whoa, I see something. Okay. And if you are able to tell the story of the bulls and the bears, because all this is based on market psychology and who is dominating the markets and how strong that domination is, or who's getting exhausted. And when you can interpret who's getting exhausted or who's dominating, you can then predict where price will move. Okay. Now we have horizontal triangles. Now horizontal triangles can either be an expanding, where each following subwave gets bigger in amplitude, or contracting, forming a wedge. Triangles may also be categorized as asymmetrical, descending, or ascending. Now, these triangles are exactly like the triangles that we saw in chart patterns and chart interpretations. They just happen to appear within the Elliott wave. So if you remembered what you saw in the class on chart patterns, and you saw the ascending, the descending, and how they look and what they're done, these are those same triangles dropped on to your Elliott wave. The subwaves may be composed of complex combinations and not just zigzags or flats. A triangle may extend by having a 5th wave also be part of the triangle. Then we have correction combinations. And correction combinations, or wave W is any flat or zigzagging wave. Wave X is usually a flat or zigzag, except in the case where a triangle is formed. Okay, so X in this case, is this level. Y in this case is this level. I'm W. Okay. And then you have a correction combination when Y and Y and X are flat. Now, it doesn't look like an Elliott wave, but when it occurs within a longer-term Elliott wave structure, you have to be able to interpret it. And then you have double and triples. Now, double and triples are no different than double and triples in chart patterns. Okay? We mentioned before a double or a triple zigzag. Here is what a double zigzag looks like. It's also labeled, has the Y, W, X, and Y. Okay? So what we have is we have a zigzag, and it occurs 3 times. A, B, C, A, B, C, and it's occurred twice at the same point. So we had a double top or a double bottom. Okay, or we could have a triple top and triple bottom. Okay, now let's go down to 3 rules. Okay, let's get it a little bit less complicated than all of these things. So wave 3 can never be the shortest impulse wave. So we learned that in the first slide. That is your rock hard rule. Wave 2 can never go beyond the start of wave 1, and wave 4 can never cross into the same price area as 1. Okay, those are the rules we live by. Without those, we don't have an Elliott wave. Now, we then have, once we've lived up to these rules, we then have the different interpretations of what is happening within those waves or the subwaves. So it's almost like a trend line. To draw a trend line, you have very specific sets of rules. Now, what happens within that trend line? What happens in between? Do you have a shorter term trend within a longer term trend? You can have all these, but you can't break the 3 basic rules. So a guideline is not a hard and fast rule that can't be broken. It is a tendency. Sometimes that happens so often that it can almost qualify as a rule, except for the times it doesn't work as expected. The guideline described below are usual ways of applying Elliott wave analysis and that have shown their validity over time. But as they are not rules, they may not work out every time. So we have rules to trade by, and then we have guidelines. So let's break down the guidelines. Okay, I'm going to try to explain it all to you again with some simple little charts, and we're going to try to put it together. The guideline of equality says that 2 of the motive subwaves in the 5-wave sequence will tend towards equality and is generally true of non-extended waves. This means that when wave 3 of an impulse wave is the extended wave, wave 5 will approximately equal wave 1 in price. This is useful for potentially projecting the end of wave 5 in an impulse. So let's see, this is wave 1. This is 4 to 5. Okay, if you were to drop the same measurement on the 4 to 5, okay, you then can predict where wave A should be and where it should recover from. Okay. The guideline of alternation with an impulse says that the form of wave 2 and wave 4 will alternate. If wave 2 is a sharp style of correction, wave 4 will be a sideways style of correction. If wave 2 is sideways, wave 4 will be sharp. So in other words, Wave 2 is sideways. Wave 4 will be sharp. If wave 2 is sharp, wave 4 will be sideways. So here we have a sharp correction, and this tells us what we could expect in here, a flat correction. Again, these are guidelines. The guideline of alternation within a correction says that the form of wave A and B will alternate within a three-wave correction. If wave A is a flat type correction, wave B may be zigzag type of correction or vice versa. It also states that if the correction begins with a more simple wave, for wave A, expect the following waves of B and C to be more complex. Okay. Now, because these are true most of the time, you have to understand what they are. But again, it's only the interpretation of market psychology and how the buyers are. So it's the behavior, it's analyzing the behavior of the bulls and the bears. So sometimes you can have this short move upward that isn't a big, loud move, and you have some buyers entering the market, prices being pushed up, it relaxes. Then all the buyers say, look at that, and they all jump in and push wave 3 up there. Or you could have had a lot of people pushing a wave A, and then they push into in wave 1, and they push into wave 3, but then in that case, you would expect them to be tired as they go into 5. Okay. Now, once they've completed 5 and they start in the correction phase, okay, where will A, B, and C be? Okay. And it's how tired are the bulls and how energetic are the bears? Okay, guideline 4 is the guideline of depth and corrective waves says that when the market goes into a correction, it often will correct into the territory of the previous wave 4 of a lesser degree. So again, we can see these are basically lines of support and resistance. Now, what I'll do is, this is the first time I've done this class. And when I built the class, I really didn't realize how much stuff I was going to give you. And I gave you the handout. But what I'm going to do is, for next week's class, I will take all of those charts that we were looking at with the rules on them, and I will put them into a PDF format, and they'll be available to you as a handout. So you can have each of the examples, because it is a lot to remember. The guideline for channeling is really a technique to project the potential end of waves within an impulse. Although channeling can be used for corrective waves, it really boils down to the application of trend lines and doesn't have any hard tendency for corrective applications. As for impulse waves, Elliott noticed that channel lines often mark their boundaries within sometimes dramatic precision. So in other words, you need to use these waves with trend lines, and as well, you can start building channels. Now, again, if you haven't come to our class in chart patterns, we'll teach you how in that class to build and recognize a channel and how to build it correctly. And you'll find that these Elliott waves move very much in conjunction or within these channels. Because remember, these are the market psychology, but what are they doing? They're building your levels of support and resistance. Now, there are 3 ways that channeling can be used for projecting the end of a wave, but that they all use the same technique. They both require 3 points beginning and ending of the waves to create their channel. One technique for projecting the end of wave 3, one technique is for projecting the end of wave 4, and one technique is for projecting the end of wave 5. So remember, you have the wave 1, 2, 3, 4, and 5. You would like to project when they would end so that you could use this to to trade and determine what price points they are. So projecting the end of wave 3, draw a trend line from the beginning of the wave 1 to the end of wave 2. Project a parallel line off the end of wave 1. There is a potential for wave 3 to end when it reaches that projected line. For projecting the end of wave 4, draw a trend line from the beginning of wave 2 to the end of wave 3. Project a parallel line off of the end of wave 2, and there's a potential for wave 4 correction at the end when it reaches that projected line. 5 is the same thing. Projecting the end of wave 5, draw a trend line from the beginning of wave 3 to the end of 4. Project a parallel line off the end of wave 3, and there is a potential for wave 5 to end when it reaches that trend line. The guideline of scale is really a technique for looking at the market and is often applied when creating channel projections. It simply states that one should use both an arithmetic scale chart and a semi-log scale chart when looking at Elliott waves. Mathematical scale charts are good for looking at waves on lower degrees, but a semi-log scale chart are good for bringing large trends, okay, or higher degrees into perspective. A channel may work nicely on a semi-log scale, whereas on a arithmetic scale, it may not. And this means you have to understand the differences in charts and how to properly use your charts and your charting tools. Now, waves have personalities. Wave personality is reflected of the mass psychology acting in the market. The emotions that flow from optimism to pessimism. And that's all that we're really talking about. Creating the structures we see in the market. The personality of each wave type is the same whether it's a higher degree wave or a lesser degree wave. Please keep in mind the 8 cycles, 1, 2, 3, 4, 5, A, B, and C. Okay. Now, what goes up must come down. About half of the first waves seen are part of the basing process and tend to be heavily corrected by wave 2. Many people feel that this is one more opportunity to trade in the direction of the previous trend. And if that was down, many will sell short. However, market breadth and volume will subtly increase. So in an uptrend, when we go from wave 1 to wave 2 and wave 2 corrects, it's a very good opportunity to buy into that market. But we want to look at volume, okay, at the same time. The other 50% of first waves will rise from large basing price movements formed by the previous correction when the other wave had ended to start. The A, B, and C had ended, and this is a good probable spot to have a wave 1 extension. Second waves tend to retrace as much as wave 1, that most of the profit gains are eroded. They tend to end on low volume and low volatility. In a bear market, this indicates a drying up of the selling pressure. However, during wave 2, most investors are convinced that the bear market is here to stay. Now, when we go into wave 3, third waves tend to be strong and broad. Remember the rule of thumb. Third waves cannot be the shortest wave. They are typically unmistakable as confidence in the direction of the new trend is clearly evident. Wave 3 usually generates the most volume and price movement. They are the most likely waves to extend. The third wave of an extended third wave will likely be the most volatile point of strength in the new trend, and things like price breakouts, continuation gaps, volume expansion, and increased breadth will accompany it. In the third wave in a stock index, nearly all the stocks will participate because the dynamics of the wave, it will provide the greatest clues to the corrective wave that is about to unfold. Now, wave 4 can be predictable in both depth and form because of the guidelines of alternation. They tend to differ from the previous wave 2 in the same degree. Now remember, using the guidelines, you would draw a trend line between 3 and 4 and then draw a perpendicular line, and that would give you where wave 4 should come to, and you could do the same thing in wave 5. They often trend sideways because the base of the final wave 5 to spring from. If a fourth wave in a stock index, lagging stocks will tend to build their tops and start declining. Fifth waves tend to be less dramatic. Okay. Now, on that note, we're going to end after these A, B, and C waves. And then, like I said, I will put these charts together for you in a PDF for next week. And next week, we're going to be putting this on live actual charts and looking for these and learning how to put them on the charts and then how to find them and identify them. So we finished with wave 1, 2, 3, 4, and 5. So we moved up. Now we're moving down. During wave A, the public is convinced that this is just a correction of the previous trend. So in other words, when gold surges to 1229 and starts to ease back down, you have a lot of people in the general public that say, it's just the buyers are easing back. They're going to keep on pushing it up. They convince themselves, and they will rush in to capitalize on it despite any technical damaging signals. This sets things up for the next wave to follow. If wave A is divided into 5 subwaves, it will be a zigzag. If it is divided into 3 subwaves, it will be flat or a triangle. Wave B catches people in the wrong direction. It forms the task of enticing the suckers to jump into the market. And it's very, very true. This is where bulls and bears traps happen. As a general rule, B waves tend to show lower volume. Okay. B waves at this point are where the professional buyers have exited the market. They're waiting for all of these crazy people to keep buying so they can so they can sell, because they need to have buyers for them to sell. Okay. The C wave tends to break the illusions of the A and B people, and they're saying, we got in the wrong time. We got to get out of this market. In a declining market, it can be devastating, and fear takes over the broad participation. An advancing wave C as an upward correction in a larger bear market can be just as dynamic, and it fools investors into thinking that it is the start of a new upswing. The fact that wave C may do this in 5 subwaves helps the deception. And on that note, we're going to end for today. This class is recorded. When it is edited and ready, it will be sent to you. Okay. And that way you can listen to all this mumbo jumbo, and I know it's a lot of words over and over again. Okay. But we will spend, like I said, I will have these charts put in a PDF for you, and you'll be able to look at them and learn what these rules are. And next week, we will be spending our time to put these on real live charts. So thank you very much for joining us, and we'll see you next week. Remember, come to our class in charts and graphs if you don't understand how to actually use your charts and set them up for this, and come to our class on chart patterns so that you can understand what these ascending and descending and symmetrical triangles are and how to build channels. So thank you very much, and we'll talk to you again very, very soon.